I think the majority view right now is the banking crisis is over. And I don't think it is. In fact, S&P has said 576 banks are dangerously exposed to commercial real estate.
Join us in this must-watch video where David Hay, a leading expert in finance and investing, unveils critical insights about the stock market and the looming risks of a recession. While the mainstream media downplays recession talks, Hay dissects hidden warning signs that investors can't afford to ignore. He sheds light on the fragile state of the banking system, the impact of inflation, and the potential rise in energy prices. Discover his advice for navigating uncertain times and opportunities in emerging market debt. Get ready to gain invaluable knowledge from a seasoned pro.
Obviously, the stock market has had extremely bad breath, market halitosis in the first half of the year. It has broadened out a little bit lately with the average stock perking up, but the median stock in the S&P is only up about 5.5%, so still way, way behind the S&P. We know it's the Magnificent Seven that's been leading the way. But I think what Peter was saying there toward the end of his comments was really critical and something I totally agree with, and I think the markets are greatly missing, and that is what's going to happen when we do have a recession. And I think where I would disagree a little bit, just because I listen to the mainstream media on a regular basis, at least if CNBC qualifies, which I think it does, their attitude is, actually making fun of people who've been saying the economy is going to have a recession. And, what are these people talking about? They keep saying all this bad stuff's happening, and yet the economy is just fine, thank you. I don't think it's just fine. I agree with what Peter was saying, but I think that's one of the disagreements I have with the consensus right now. Because if you look at, I think Peter touched on this, we got an industrial recession. We've got actually falling GDI, gross domestic income, which is arguably more accurate. And if you put GDP along with GDI, you get the GDP plus, and that's clearly flashing recession. You've got a yield curve that is deeply inverted, that's had a flawless track record when it's been this inverted. You've got the leading economic indicators falling for 14 straight months, and they're called LEIs for a reason. They do lead. Yet the market's really blowing that off. And, you could kind of look at even the transportation average, which is up 16% this year. And that's pretty remarkable if we really are on the cusp of a recession. You say, well, that's airlines, trucking's bad, cardboard recession underway. And there's lots of cross currents, I think, to be fair. So I think if a person wants to take an economically optimistic outlook, they could. But I think it's looking at generally lagging or at best coincident. And if you look at the leading stuff, it's flashing orange, if not red. So I think that's what the market's missing right now. As Stan Druckenmiller said recently, that when you have money too cheap, people do stupid things. And when you have money too cheap for 13 years, people do really stupid things. And we've seen a ton of that. I mean, I do think bubble 3.0 was the biggest of them all. The first being the tech bubble of the late 90s, then the housing bubble of the 2005 to 2007 period, which almost brought down the global financial system. And that's really one of the points of my book, which when I wrote it had not morphed into a banking crisis this time, as opposed to the bubble 2.0, which involved mortgages. But what Peter's saying is I absolutely agree with. And again, I think the consensus is missing this. I think the majority view right now is the banking crisis is over. And I don't think it is. In fact, S&P has said 576 banks are dangerously exposed to commercial real estate. And as Peter already touched on, commercial real estate is a disaster, at least in certain parts of it. Clearly office buildings, where you're seeing the commercial equivalent of jingle mail, where these guys are basically just turning their buildings back to the lenders. Chris Whalen, who was way ahead of this, a lot of people believe, I think the consensus viewpoint again was early in the year, late last year, that higher interest rates were good for the banking system. And he was saying, whoa, up to a point, but it's gone way too far. This is going to become a systemic problem. He was right. He thinks that all banks are suspect. And I think what Peter was saying is true, that the first part of the banking crisis, was because of their safest securities. What I believe, once again, the market's missing is the second part of the crisis is going to be the hits on their loan book. So I think that's a major problem. And I think it ties in with corporations and the high levels of debt that they have. Not only are the levels high, but a lot of it's floating rate debt. So you're getting an immediate impact on companies' cash flow. So that's a big issue. First of all, there's been a lot of deflation that's occurred since I wrote that book. That we published it in early 2022 when it was still, almost at its maximum size. But even with this, what I'd call the echo bubble that we're getting right now, there's still been a tremendous amount of damage done. But I think that, what you've seen with the NASDAQ 100, which is just like the overall market, incredibly concentrated rally in a few names, that's probably a pretty good hedge for people that are looking to protect from the next down leg. I would say, puts on the NASDAQ 100 wouldn't be a bad call. And I think Apple's a great company, but it's 30 times earnings. Revenues have actually been negative, and yet it's trading at a $3 trillion market capitalization. Hard to make money on those kinds of stock, I think, over the next 10 years. I think where you're really going to make good money is in some of the bombed out commodity areas, which has, of course, been helping the Fed in its battle with inflation. We've seen a big drop in things like lumber and, of course, even oil. But I think that's what is going to be the big shock in the second half, is I think you get another spike coming in oil prices. We've talked about this before. I think oil inventories are just dangerously low. That's been another government intervention with all these SPR, strategic petroleum releases, which have made it look like inventories are fine, but they're not fine. And that's going to hit the fan here, I think, very soon. And that could be the next problem that the Fed is facing, is more energy inflation. I would agree with Peter that the Fed has just created an untenable situation. I actually, to go out on a limb, I believe that Jay Powell's going to resign sometime between now and the end of next year, because I don't think he wants to be around when the Fed has to do what Peter was talking about earlier, which is get back into debt monetization mode. I think one of the words we're going to hear more and more as time goes by is fiscal dominance, which is basically the idea that the Fed has to finance the government because nobody else will. And as you know, one of my big fears for the second half of this year is what I call the 4F scenario, the federal fiscal funding fiasco. I just don't see where the trillions of dollars are going to come from to finance the government at these kinds of interest rates. I think ultimately it's going to have to be the Fed that does it with their magical money machine. And that will be not great for the stock market, but it could be great for commodities. And I think that as inflation has been non-transitory for as long as it has, then you start to get labor militancy. And you're seeing that with the UPS contract right now. So you're getting a wage pressure that you haven't had in many decades. And wages are inherently sticky, right? It's hard to cut people's pay. And the way to deal with that is to do layoffs, and companies are starting to do that. And I think that will continue. And I don't think the jobs market is nearly as robust as the official statistics. A lot of that's due to the birth-death model, which is overstating business formations and understating employees, basically being terminated. So I think it gets back to how confusing the situation is. And I think that's typical at inflection points, which I think we're in the midst of. I think we're in the process of inflecting down. And one thing that I would bring up that kind of touches on what Peter was saying is that where I think Powell is really naive is this belief that inflation is going to get better over the next few years. I think it's going to get worse over the next few years. I think we're going through a period caused largely by falling commodity prices, especially energy, where inflation looks relatively calm right now, again, backing out wages. But a lot of the forward-looking inflation statistics are actually looking relatively encouraging for now. But I think we've got these underlying structural, secular upward forces on inflation, such as reshoring. That's one thing that's happening. If you look at construction activity, like for plants, it's just absolutely going ballistic right now because we are trying to reindustrialize America. That's got some very positive aspects, but I think it's inherently inflationary. You and I before have talked about what I call the great green energy transition or greenflation. That's by definition inflationary. We're replacing more efficient sources of energy with less efficient sources of energy. So you've got these kind of underlying upward lifting forces on inflation, but near term, it looks okay. And that happened in the 1970s. If you went back and look I don't think Powell's going to stick around. He's not going to go for that. He's not going to do QE6 or whatever number it is. So that's why I think we're going to have somebody that's more pliant, believe it or not, than he is at the head of the Fed. But I also think it's important for us to think about what should investors do instead of, we've obviously both like commodities and gold is a logical hedge and so forth. And there's people that love crypto for that reason. I think Peter and I are both crypto skeptics. But what I do think makes some sense, because this is the time in a investment cycle where I would normally be extending duration for clients and buying long-term treasuries. I don't want to do that for all the reasons that Peter and I have talked about. But I think people need to be locking in yield at this point in the interest rate cycle. And I think where there's really an opportunity is with emerging market debt. Certainly not all emerging market countries, not Turkey, but you look at countries like Indonesia, even Brazil, where Brazil's got interest rates of 14% with inflation down in the 4 to 5% zone. I mean, that's like Paul Volcker. So what's ironic is that many of these emerging markets have actually been following more responsible fiscal and monetary policies than the West has, and certainly the
Yeah.
US.